What a start to the year it's been for the stock market. For many markets around the world, it's been the worst month since the start of the pandemic back in March 2020. The ASX at one point was off over 10% from its highs in August. The S&P 500 was also down around 10%, and the Nasdaq was hit the hardest, down a whopping 16%. Now, if you've been following me a while, you won't be surprised that the tech-heavy Nasdaq was hit the hardest. For stock markets, this drop in 10% is actually correction territory, and there's a lot of fuel feeding this fire. Everything from inflation to rising interest rates to changing monetary policy, particularly from the Fed, and there's a few geopolitical tensions with Russia thrown in there just for good measure. And today, we're going to discuss all of these things and help give you a better idea about what's going on and what you should be doing. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos like these where we go over some of the key financial topics that are affecting markets and investments in general. Let's kick this one off with the big horse, inflation. Here in Australia, our latest inflation figures came out at 3.5% for the year to December 31. Now, this is a lot higher than many analysts were expecting, and the underlying inflation, which is arguably more important, came in at 2.6%, and this is now years ahead of the RBA's official forecasts. For those of you who don't know the difference between what headline inflation is and core inflation, headline inflation is a basket of goods that includes a couple of extra things like food and energy prices. Core inflation, on the other hand, strips out those two because they're a little bit more volatile. Everyone knows that the fuel price is up and down like a toilet seat. If we have a look at what inflation in the US is doing, they always go bigger and harder than us Aussies. Their inflation rate is sitting at 7%, and late last year we saw Jerome Powell, the head of the Federal Reserve, drop the transitory rhetoric. And it's important to distinguish between transitory inflation, which is due to supply chain bottlenecks, and more persistent inflation, because one will sort itself out over time, while the other is going to need some tightening of monetary policy in order to curb the inflation moving forward. And unfortunately, at the moment, it looks like we're facing the latter. Majority of the volatility in January has come about when Jerome Powell, the head of the Federal Reserve, said that current conditions mattered for the pace of policy adjustments. Reading between the lines, this basically means higher interest rates sooner. Putting up interest rates is a little bit like throwing a bucket of cold water over the economy. So it's basically going to mean that the cost of existing borrowings are going up, so you're going to have to spend more money on interest charges for any existing loans. And it's also going to deter people from taking out as much new debt because the opportunity cost of doing so has risen. And in terms of the stock market, there's really two key factors that rising interest rates has on stock prices. Firstly, over the last few years, we've seen investors switch out of defensive assets like cash and bonds and move into more growth assets like equities in order to generate a return on their capital. For some time now, you've generated a negative real return on cash because the inflation rate is higher than the interest rate, which means the purchasing power of your money over time is actually going down. And if interest rates do in fact rise, there will be a tipping point where investors will start considering putting more defensive assets back in their portfolio again, as they can start to generate a return on those assets without taking the risk that comes with equities. And while we don't know exactly where that tipping point would be, we do expect it to be somewhere around when the 10-year bond yield moves meaningfully above 2% and approaches closer to 3%. Now, to date, most of the movements in the bond yields have been in the early part of the belly of the curve without the 10-year bond yield moving too much. And we do think that this tipping point is some time away yet, but you have to remember that markets are forward-looking and they factor in these elements early. Secondly, stocks are generally valued on their potential future earnings. So if interest rates increase, companies that place a higher emphasis on future earnings, so think your growth stocks, they're going to be impacted more due to the discounting effect of rising interest rates. And this is why the Nasdaq has been hit the hardest. Now, we can't talk about the recent volatility in markets without mentioning the 100,000 Russian troops that are sitting on Ukraine's border. If Russia does decide to invade Ukraine, not only would this be disastrous for human lives, but also it will create tensions between the West and Russia, and this creates a lot of uncertainty, and the market does not like uncertainty. So there is a lot going on at the moment, but the real question is, what should you as an investor be doing at the moment with your portfolio? Firstly, you need to decide if you are in fact an investor or if you're a speculator. Now, a speculator is going to look at all this really bad news, fear the worst, and sell down their holdings in panic. And they might be right. The market may continue to drop, but they may also be wrong and they may miss a recovery. An investor, on the other hand, is someone who holds a diversified portfolio of assets. They make changes and tweaks to that portfolio as economic conditions change and their personal situation changes, but ultimately they don't sell in panic. An investor was likely expecting this kind of a pullback in their portfolio, and they may even see it as a buying opportunity. My suggestion to you guys is to be an investor. You shouldn't see the stock market as a way to make some short-term cash. The stock market is a tool to use to build some real wealth over the medium to long term. And so when there is a 10% pullback in the market, in the long-term scheme of things, it's really quite insignificant. As this chart shows, a pullback of 10% or more has occurred 11 times in the last 20 years. So it really isn't uncommon, and if you can't deal with that kind of volatility in your portfolio, then you shouldn't be invested in stocks. Now, don't get me wrong, I'm definitely not saying that we've hit the bottom, because I have no idea where the bottom is. I think if I had to guess, I'd say we're in for a pretty wild ride this year as monetary policy keeps changing. But in order to be a good long-term investor, you really need to see these drops as opportunities and not threats. Now, aside from the stock market, I just wanted to touch on a couple of other things. Now, we've seen the Australian dollar drop below US 70 cents, which is its weakest level in 18 months. This isn't so much due to anything we're doing here in Australia, it's more on the back of a strong US dollar, because it looks like the US is going to start increasing interest rates a lot sooner than we are. And so money typically flows to the higher interest rates, so the US dollar is appreciating at the moment. And the oil price is back up again and expected to rise further thanks to speculation that China's demand will once again increase. Now, this is great news for Australia as iron ore is our biggest export industry. But that's it for me today, guys. Thanks a lot for watching. I know there was a lot to take in there, a lot to digest. So if you have any thoughts about it, leave it in the comments section below. I'd love to know what you're thinking. But otherwise, I will see you guys in the next one.